The views expressed in this video are those of the panelists and do not necessarily reflect the views of U.S. Money Reserve.
Welcome to America's Gold Authority podcast. I'm your host, Mike Barnes. Governments around the world affect the price of gold. What's happening in places like Japan and France recently, as well as here in the U.S., boosts gold prices. Central banks are now holding more gold than U.S. Treasuries for the first time since 1996. And there's a reason for this higher demand, as you'll see in this clip from U.S. Money Reserve's TV show, The Global Gold Forecast, that features U.S. Money Reserve President Philip Diehl.
The Global Gold Forecast, presented by America's Gold Authority, U.S. Money Reserve. Central bank demand. Gold as a global hedge. Central banks around the world are buying gold at record levels. It's part of a trend that began in the aftermath of the global financial crisis, when Americans lost an estimated $17 trillion in household net worth. Suddenly, central banks went from net sellers of gold to net buyers, turning to the precious metal to help protect their nations from financial ruin. In fact, over the last 20 years, central bank gold demand has soared by nearly 260%, and that trend shows no sign of slowing down. In 2022 alone, these government institutions purchased more than 1,130 metric tons, worth an estimated $70 billion. Since then, central banks have purchased more than 1,000 metric tons of gold each year, smashing previous records. Historically, nations like Russia and China have been the largest purchasers of gold, likely in a bid to distance themselves from the dollar and reduce the impact of U.S. sanctions. More recently, nations such as Poland, the world's top gold buyer in 2024, are using gold to help shield their reserves from the instability generated by international conflict. For both governments and citizens, gold provides an insurance policy against inflation, currency risk, and systemic failure. And as long as global uncertainty continues, central banks will remain a major force supporting record gold prices for years to come.
Just to give you an illustration of the potential here, China has been a big buyer of gold in recent years. 3% of their total assets that their central bank owns, only 3% is in gold. The United States, 60% of our assets are in gold. And probably the average among the large countries may be in the neighborhood of 40%. So China going to the average is an enormous amount of gold that in the future I expect them to be buying. Likewise, Russia, Iran, the people who are aligning against the United States and the West are increasingly interested in detaching themselves from the leverage that the dollar represents.
You mentioned Russia in that clip. China apparently has been buying gold for the last 11 months in a row. What is this saying about central banks?
Well, China has been the big gorilla in the room, if you will, over the last 3 or 4 years. Before this rally began, China really weighed in with a lot of gold purchases. It really had escaped the notice of most of the marketplace until the rally began to take off 2 years ago with the Hamas attack on Israel. And in short order, we had additional fuel added to the fire with expectations that the Fed would begin cutting interest rates. And about that time, people began to notice that the Chinese were ramping up their their purchases of gold. Now, those decisions came in the wake of Russia's invasion of Ukraine and a recognition that Russia, for years before its decision to invade Ukraine, had been stockpiling gold as a way of protecting itself against the inevitable Western sanctions it faced after its after its eventual invasion. So there's also has been a lot of speculation that that's what the Chinese are doing. They have stated an official government policy that they want to be ready to take back Taiwan by 2027. Of course, that's right around the corner now. It doesn't mean that they will actually act in 2027 to do so, but they want to be ready, and they're apparently on course to do that. So all of that has drawn a lot of attention to central bank gold buying. And one of the things that has really changed over the last couple years since the recognition that China had weighed in heavily is that additional central banks have joined the movement and are likewise buying gold.
Brad, as the Director of Education at U.S. Money Reserve, tell us what's so important about the fact that central banks are now buying more gold than U.S. Treasuries.
Yeah, it started a long time ago. I think in order to understand why they're doing it and why it's important, you need to understand what their goals are. A central bank is their role is to help stabilize and manage their monetary system and their financial system internally. So they need to be able to manage their currency against too high of appreciation to hurt their exports and depreciation that hurts their purchasing power and keep a level of stability. They need to be able to keep money flowing through their economy when their financial system needs access to other currencies. They keep reserves in order to be able to get those into their economy to be able to do what they need to do. And we saw this pivot really back after the global financial crisis, starting in 2009 and 10, is where central banks, after Bretton Woods, had been net sellers of gold all throughout the 80s and 90s. They pivoted to become net buyers of gold back at that point in time. And they've been buying gold ever since. And you think about what happened at that time, that was a situation where credit froze up. Dollars were not, that the world needed as the reserve currency, were not flowing around the world the way that they needed to be. And other countries got hurt. Federal Reserve stepped in, provided dollars through swap lines and different things, but it was really an eye-opening moment, clearly, for central banks at that time, that they don't want to be completely dependent upon the dollar system. Regardless of the value of the dollar or anything else, the system itself and the access to them was a threat. And that was clearly evident. So they've been buying it ever since. And for a lot of the reasons that Philip mentioned and others, that they've just ramped up ever since. So the other thing, especially recently, is this administration has been very clear that the idea of having treasuries on balance sheets, foreign central bank balance sheets, has been a problem that has created some of the economic divide. That is at least their belief. Stephen Marin, who's Trump Economic Council of Advisors chief, I guess you'd call him, and he's been recently put on the Federal Reserve Board, wrote a paper last year, and we've talked about it here quite a few times, where he literally says that one of the problems with the sort of deindustrialization of the United States and having to buy, and us buying way more things from China, has been fueled by the fact that we've supplied the world with the reserve asset of the Treasury that's kept the dollar artificially high. And so they've been pretty clear that they want the dollar to come down. In order to rebalance, that reserve asset role has to change as well. So this is certainly not a surprise to anybody that's been watching and paying attention. It's whether right or wrong, it's been a stated objective by the administration for quite a while now.
Yeah, I think that I think we need to recognize that there have really been two forces at work over the last 25, 30 years that have changed central banks from net buyers of gold to net sellers of gold. And not all central banks are equal. The Western central banks during the 1990s began the process of stopping selling gold. They began to hold on to their gold, and that especially occurred in Europe. And it didn't happen all at once. It happened gradually over the course of 10 years or so. And during that period of time, you can see on the charts how total central bank gold buying or selling really began to shift. It was still net selling of gold, but that net became smaller and smaller until you got into the 2000s, where it basically became balanced. And then, as Brad just described, with the onset and in the wake of the great financial crisis, then we began to see that ramp up of gold buying, not by the Western central banks, which had basically frozen how much gold they were selling, but now we had buying from other central banks, such as Russia and China. And it's not just the opponents of the United States and the West that are buying gold. We're seeing members of NATO become major buyers of gold, like Poland and Turkey, as tensions have ramped up between NATO and Russia. And so gold is playing its traditional role. This is something we emphasize to clients over and over again. The gold is the go-to asset in times of great economic and political uncertainty. And it's not just for individuals, it's for central banks as well. And we have really seen this develop over the last couple of years, and we're seeing it intensify here in 2025 as there's increasing uncertainty about U.S. policymaking and about the state of the world in geopolitical uncertainty in the Middle East, in Europe, and in the South China Sea with Taiwan and China.
Philip, should we as consumers be paying more attention to the central banks and what their long-term strategy is?
Yes, absolutely, because the longer the banks continue to buy and actually increase their buying of gold, they're buying in massive amounts. And this has an impact on gold prices that we all pay. And so this is going to be one of multiple factors I'm convinced are going to continue to grow gold prices and the value of gold holdings in a portfolio. And it's not the only one, but unless you believe that in the threat of inflation and recession and world peace is going to break out around the world, and that the U.S. is going to back off its weak dollar policy, and that all these geopolitical types of tensions are going to really disappear. And I don't know anyone who is that optimistic. I think we're going to see a continuing favorable environment for gold.
Brad, all of the things that Philip just mentioned about the geopolitical tensions, the inflation concerns, the weak U.S. dollar, it's like the stars have aligned and gold is reaping the benefits as it hits over 4,000.
Yeah, and it's just getting started. I mean, what we're seeing here, I've said it all year when we talk about what the objectives are here in terms of realigning global trade, are things we're going to look back from 20 years from today and say things work different after this shift. Things don't work the same. The paradigm is moved. What we've seen for the last 30, 40 years, it's going to be very different. And you have to think about why that is. I mean, for the last 40 plus years, and actually longer, but even after we went off the gold standard, the dollar was still the centerpiece of the financial world. If two countries that aren't doing any trade with the United States are doing trade among one another, even then, the dollar is the primary asset that they would trade through between those currencies. And if we're not going to be exporting dollars through trade deficits, because we're buying more stuff and sending dollars overseas, there's not as many dollars over there, as countries are kind of divide into these trade blocs with U.S. and Western-centric trade blocs and Eastern Chinese-centric trade blocs, you have to think that those countries, especially that are not in the U.S., trade bloc, have to have some kind of alternative, and there really is no other alternative. China clearly wants the yuan to be used as a medium of exchange through currencies, but they're also not willing to do what the United States was willing to do once upon a time, which was provide reserve assets to the world. They have very strict capital controls, and they don't want to do what the United States did ultimately. They want to protect their manufacturing base. So there's a tricky situation for them in getting their currency out into the world to be able to use for trade and become the sort of centerpiece of that Eastern trading bloc, but without following the same method that the United States did, which is supply the world with government debt that will create the same kind of problems. And it looks like they are pretty clearly turning to gold as the answer there. The Shanghai Gold Exchange is a huge trading bloc for gold. They have affiliations in trading regions like Singapore. They're setting up vaults in Hong Kong and potentially even Saudi Arabia. They're inviting other trading partners to start now having their gold stored within the Shanghai Gold Exchange vault system, which will allow for settlement with a neutral currency among those currencies. And we don't, rather than settling with dollars as is been done in the past. So it's going to be a very, very different system, and you can very clearly see the direction that they're taking it, with gold being the centerpiece of that.
Yeah, I want to address some of those issues as well. I don't know, over the course of history, hundreds of years of history, of a country ever giving up the blessings it gets, the advantages it gets from holding the reserve currency. It's really effectively been stripped from them because of massive failures or events in the world around them. And what we see here today is a number of great experiments that are going on in the US and in China. And it's entirely possible that the experiments fail. That may be the worst case scenario here. We may go, if the experiments succeed in some way, we may go through a period of transition, temporary transition, in which there's a lot of turmoil and then things begin to settle out. The degree to which they settle out to our advantage is an open question. I think there'd be a lot of debate about that, even if the transition succeeds. But the darker case is one in which the transition and these experiments around this transition fail. And somebody, the world basically, is left to pick up the pieces. And who knows what we get out of that process? It's just a tremendous amount of uncertainty. I completely agree with Brad that whenever we come out of it, whether it's as a result of the success of the experiment or the failure of the experiment, what we're going to see is something very different from what we see today. And again, it may not work out to our advantage. The other thing that really occurs to me is when we talk about China and the possibility of China taking the role of providing the reserve currency or leading a large part of the world, the trade world, into a new era. The thing that we cannot overlook is that businesses count on the rule of law. You cannot reliably do business in a country unless you're willing to take great risks when a government can step in and expropriate your resources in a moment's notice or no notice at all. And we've really seen that in Russia. We've seen it more often in China. There are many companies that have learned the hard way that without the rule of law, their investments are at risk. And really, the United States, Western Europe, Japan, the rule of law is much more stable and protected. So that's an advantage that the U.S. will continue to have over China for the foreseeable future.
And one point to add to that is that's kind of why gold is taking a centerpiece over there, right? Because China can't actually control gold. It's a neutral asset. And they're setting up vaults, even though it's through the Shanghai Gold Exchange, they're setting up vaults in other areas of the world because it's probably, for the reasons you state, unlikely that many countries are actually going to vault their sovereign gold within the Chinese borders. But you vault your gold in your own country. It's just operated by Shanghai. There's not really a risk there, but it ties you into that monetary system. So it seems like China recognizes that as an issue and is starting to put in building blocks in place to be able to sort of overcome it in one way or the other.
Well, it's sort of an admission of the problem by China, that rather than submitting itself to the rule of law, it is making a commitment to still position, or an attempt to position itself as a powerhouse in the financial system by finding ways that reassure investors that don't worry about it. We have a way for you to deal with this without us changing the rule of law. The thing to remember is that the Chinese public are a huge portion of the demand for gold these days, because their other investment opportunities have gone down the toilet, and gold has been the one asset that they have been able to rely on. And it's been a great investment for them. But if the Chinese government were to decide to seize the gold of foreign citizens, I mean, it would create a view of Chinese citizens. It would definitely create a lot of turmoil. But the Chinese have been willing to take that risk, for example, on its COVID policy and other policies. And it just crosses those bridges when they come to them.
Let's finish up with a look toward the future. Q4 has started off amazingly for gold, going over $4,000 an ounce. And already 2025 is the largest gain percentage-wise for gold in 1 year since 1979. And I think both of you think this is not slowing down. Philip, do you agree?
Yeah, I definitely agree. And the comparison to 1979 is problematic. And the reason is because there was this incredible speculative bubble that drove gold prices in 1979 as inflation heated up, and in the wake of the oil price rises due to the embargoes. And so there were only really two factors driving gold at that time. Today, I could easily describe 8 or 9 forces that are driving gold prices. And what we've seen, I mean, if you compared the 1979 chart and laid it on top of the last 2 years during the rally, you will see that the pattern of gold increases involve a significant increase in prices, followed by a period of time in which those prices consolidated, and then followed by another increase. And sometimes there have been minor corrections, maybe $150 or $200 or $50. But in a matter of days, in most cases, those corrections have been overcome and the price has continued to rally. So I think these prices have a much firmer foundation than was the case in 1979. And the 8 or 9 forces that are driving gold today are sustained forces. And there are other forces on the horizon that could enter the picture and also would drive gold prices. For example, if we saw a major correction in the equity markets, I think we'd see a very strong flight to gold after there would be an initial fall in gold prices as people had to sell gold to cover margin calls. We saw that in the great financial crisis. But once that initial set of sales of gold occurred, then people would be rushing to gold for its traditional role of being a store of value and a hedge in a storm.
Yeah, 100%. The things that you described during the 70s, those were sort of just economic environmentals, but the current monetary system that we're using today was firmly growing. right? It wasn't a different system altogether. It was actually entrenching the dollar-based system that we have now. And what we're seeing right now is the opposite. It's a dismantling of this sort of globalized world into these regional trade blocs where the dollar won't be the only big player in the world as it is today. And that is a fundamental shift that makes it, to your point, very, very different than what we saw back then.
Yeah, the geopolitical situation, the comparison of the geopolitical situation between 1979 and today is another great example of how different the world is today. What we were talking about in 1979 and 1980 was the Soviets' invasion of Afghanistan and what was a very contained war that did not imply the possibility of direct conflict between the West and the Soviet Union. That is obviously very different from where we are today, in which there has been a war in the Middle East in which it's easier to name the number of countries that have not been involved than there are the number of countries that have been involved. It's spread throughout the region. We have a situation today where NATO is preparing for the possibility that the Russians will begin aggressive action in the Baltics against NATO members within 6 to 12 months. And then there's the ever-present danger of a direct conflict between the West and China. It's nothing. The geopolitical situation today is far more dangerous than it was back in 79 and 80.
Definitely a new era. Phil Diehl, thanks so much for joining us today.
My pleasure.
And Brad Chastain, thank you as always.
Thank you, Mike.
That's all the time we have for today's episode. On behalf of all of us here in the U.S. Money Reserve Studios, thank you for tuning in. If you have any questions or want to learn more about today's episode, you can call the number in our episode description and speak with one of the friendly account executives. They will be more than happy to answer any questions you may have about precious metals and the strategic role they can play in achieving a secure and comfortable financial future. I'm Mike Barnes. We'll see you next time on America's Gold Authority podcast.
The markets for coins are unregulated. Prices can rise or fall and carry some risks. The company is not affiliated with the U.S. government or the U.S. Mint. Past performance of the coin or the market cannot predict future performance. All calls recorded for quality assurance. Offer void where prohibited.